Welcome back to Click Capital, your go-to channel for market analysis and all the latest data and charts. If you're watching the channel yesterday, you saw that I said I think we're going to have a bit of a bounce today, and that's exactly what's happened. NASDAQ and growth tech stocks actually had a really good rip today, with the NASDAQ up 2.6%. If you're watching yesterday, you also heard me say I got my portfolio more towards flat. It was only 20% net short coming in today. Stay towards the end. I'll let you know how I'm positioned going forward into tomorrow's big quad witching day, which I think you'll find interesting. But let's go and have a look over at the heat map. So a bit of a sea of green out there today. It was pretty good breadth and a pretty good jump across the board, especially in mega cap tech. We had Microsoft up 4%, Google up 4%, Amazon up 4%, Meta was ripping higher as well. Oil and gas bounced back. Healthcare did okay, except for the big guys. Johnson & Johnson, Pfizer, Merck were all a bit flat. Consumer defensive came off, and the banks had a little bit of a bounce today with some good news. The Fed injecting a huge amount of liquidity, and the banks coming together to save First Republic, so that helped a lot. Over to economic data. I didn't dive too deep into this because I don't have any positions in the housing home builders at the moment, but they did appear to come in a lot stronger than expected. I'm not sure what's happening there. If someone's got a bit of insight on housing, please let me know in the comments down below. I would love to know why they come on so stronger than expected. And jobless claims came in better than expected as well. So still a tight labour market out there. Tomorrow we just got some consumer sentiment, but we got quad witching tomorrow. It's where we got quarterly futures and options on stocks and indices all expiring, and then that can normally produce a lot of volume and volatility. So tomorrow could get a bit spicy. Fear and greed jumped 10 points today. From yesterday we're 19, today we're at 29. So there was a bit of optimism in the air out there today, but in my opinion it's more a sigh of relief than anything. Fed fund futures probability on a hike rate jumped significantly today. Yesterday we finished at 62%. Today we're at 81% chance of a 25 basis point hike, only 18% chance of a pause. I think with this risk on equity sentiment we've got today, now we've got NASDAQ well and truly above the 50 bar. This is giving J Powell to hike. If markets are settling down and they're okay, labour market's still tight, inflation's still there, he can just hike into that. He got full permission now to hike if there's a lot of, markets are well bid and supported. So as long as risk markets stay up, I think he's going to hike. Otherwise, if we get another bad headline, something else falls apart, then the Fed put will come into place like it always does. So the banks get together, all the big guys get together to deposit $30 billion into First Republic. And that got people a little cheerful today. But overall, I can't see how that's a good thing when all the biggest banks have to get together and deposit money into one of their competitors to try and, put faith back in the whole banking system. That's a big storm that the industry is going through. So while this is plugging the hole for now, how many times can they do this? How many other First Republics can they deposit $30 billion into? So, things are moving very quickly here and they're trying to get ahead of it. But, there's a lot of people are wiring out of regionals into the big four. So it's just going to make the big four even more bigger and concentrated. And I don't think we've seen the end of this. I know they're all hoping this is all done, but I don't think it's all done just yet. And here's the Fed's balance sheet. Just thought I'd highlight this today. So here we are before COVID in Feb 2020. We're at 4.1 trillion. We got up to almost 9 trillion, and now we're still at 8.3 trillion. So the Fed's balance sheet is still double pre-COVID. And it was only, in 2008, it was below 1 trillion. So in a bit over 14 years, they've blown out their balance sheet eightfold. And this right here has been the biggest contributor to why we've seen the everything bubble. There's just so much liquidity sloshing around. It's why we saw companies up here trading on 50, 100 times sales that are losing money every quarter. It's why we saw people spending millions of dollars for a picture of a monkey. This is why we saw valuations get as high as they've ever got for a lot of sectors of the market. So sure, they could have done some, quantitative easing and pumping liquidity into the system. In the GFC, things, I remember back then, things were really bad. Everyone thought they should step in. And, the economy and unemployment did stay high until 2010, 2011. So they could have kept it going there. But what they should have done in hindsight, and I think they agree to this even though they don't want to openly admit it, is they should have tapered off. Because risk, equity markets, unemployment rate, everything was fine. But instead, they just kept going and kept going and kept going. And then they were starting to taper off in 2018. Market had its taper tantrum and won, and then COVID happened. So now this is the huge problem with their huge balance sheet, and this is what just keeps supporting the market, all this liquidity. This should have been wound down to 1 trillion coming into 2018. Instead, they just pumped the system full of liquidity for over a decade, and then they had to go again with COVID. So the trend is down, quantitative tightening, but if things getting bad, they'll stop that and go back to easing. But this is what needs to come down for markets to be, healthy and normal again, because it just keeps being artificially inflated. We have a global pandemic, and then risk assets, property and stocks shoot up to the moon. Now we've got banking failures, and looks like we're getting pumped with liquidity and ripping again. So is this a world we live in, upside down world, where bad things are good? What if if we have a nuclear war, are they just going to flood the markets again, and we're going to rip higher as well? So things have just got to start making sense again at some point, and this is why modern day markets are just so distorted. But anyway, you've got to adapt to the environment, but just thought I'd point that out, the big fundamental picture here going on. Here's a chart of 2-day change in 2-year Treasury yield, and we can see the 87 crash had big movement, and same with September 11 and GFC. And then after the Fed started, pumping the system full of liquidity, it just absolutely dampened volatility big time. And I remember back here in 2012, 13, 14, people were saying, we'll never go back to this volatility because of modern day markets. There's such good data now. High frequency traders actually help dampen volatility. Electronic markets, everything going away from the floor to the screen. And, we're in a new paradigm, a new era. We'll never see these big volatility movements again. Fast forward 10 years and we're breaking records. And the thing about volatility is there's what's known as volatility clustering. And volatility really just has these, 1 day or 1 week spikes and goes back to normal. They kind of form what's known as kind of like diamond shape in the volatility. So we'll go into like volatility regimes. Here was obviously a really low volatility regime. And then coming into COVID, we can see that diamond, and then we've got it here again as well. So this volatility is going to hang around for a while in the bond market, and that spills into other markets as well, because everything starts with credit. So we're at levels the same as GFC, even higher than GFC now, right now as we're speaking in bond market volatility. And what contributes to that is the liquidity falls off as well. So here's the bid-ask spread and book depth on the 2-year T-note futures. And you can see here from February coming into March, we had pretty good depth here, and then it's completely dried up. So these high-frequency traders and market makers and that, when volatility picks up or there's a lot of fear and stuff, they'll still make a market bet with way less size. So if they normally post 100 contracts on a bid and ask, they might only post 10 or 20. And that can exacerbate the moves in the bond market and all markets, because if someone needs to get out, they have to chew through a lot more bids and offers to fill their position. So market makers and high frequency traders are pulling back their liquidity from this market. Here's another interesting thing that kind of is a bit buried down is Gen Z and millennial auto loan default rates are soaring. So we already know that before all this banking failure mess, that lending standards were getting tighter and defaults are on the rise. And we're really seeing that in the auto loan market. A lot of millions of Americans have negative equity because everyone shot up used car prices during lockdown and COVID, became a bit of a bubble, and now that's crashed down to below before COVID levels. And so a lot of people took out car loans here with low interest rates and high prices, and now the prices have come down and interest rates have shot up. But there's still a lot of jobs out there. However, if you can imagine in this situation we're in now, with high interest rates and people having negative equity in their cars and homes as well, what happens if they lose their jobs when they've already got record credit card debt, record low savings rate, negative equity in their cars, and developing in real estate? Things could turn very bad very quickly. So that's a little bit of data that's going on under the hood there that not a lot of people are paying attention to. But over to the markets. So we had a bounce today, as I thought we would. We got pretty oversold there. Even the equal weight got up 1.2%. But NASDAQ, look at that. Huge. I think that is, apart from this day here on February 2nd, we topped. I think that's the second biggest day we've had all year in the NASDAQ. So it was a big bounce across the board there in growth risk assets, as mega cap tech appears to be the defensive play once again, and the Fed's come to the rescue. Moving on, we can see internationals popped as they always follow what's going on in the States. Volatility came diving off, especially up the front here. But we've still got VIX 9-day at the 24 handle, above VIX at 22 handle. So not out of the woods yet, and VIX 3 months at 24, above VIX. So is the volatility options market saying that volatility is going to stay elevated for a while? It doesn't expect it to come back down in 3 months. Volatility was off today, but still really elevated here at 110. Move index pulled back a little bit, but still very elevated as well. And put call ratios. Look at this put call ratio in equities, 0.86. So there's a lot more people buying calls out there today than puts. Market's not worried at all. And we saw that with meme stocks rally today. But breadth, if you take a look at breadth, it hasn't popped as much as you would think here. We only got 26% of stocks above their 20-day average. So that's still really low. And the 50-day hasn't actually broken out. Stocks above their 50 bar, that hasn't actually bounced. It didn't take out the highs from last week. And above their 200-day average, had a little pop here today, but still below where we were on Monday and Tuesday. So that hasn't really turned around in breadth. And if you look at if we look at ETFs and stocks making new highs, that is just really shallow too. Just go down to a 3-day. That's ETFs making new highs, NYSC really low, and NASDAQ as well. So this doesn't look like a new bull market to me. Over to spreads, gross cyclical versus defensive. Had a nice little pop here today, but it looks to be building a divergence. Equal weight SP versus normal SP, still getting slammed. That's mega cap tech just outperforming for you. So most stocks are much weaker than the big concentrated stocks that make up, 30% of the SP 500. Moving forward, we had high beta versus low volatility have a nice little bounce here today, and growth versus value popped up and ripped up again. You saw me talk about this when we broke out here. It looks like it's going to pop up. But if we zoom out to a bigger monthly chart, I'm not sure that we're out of the woods yet, even if we go to a 3-month chart. So we all know this since the, basically a GFC, even a year before it, the big story has been gross outperform value. The ratio went from 0.86 up to 2.2, huge outperformance. And this is, I think, broke the record for how long and big the outperformance of growth got over value going back in all of history. Normally over the long term, value outperforms growth, but we've all become so brainwashed, it's actually the opposite. So we've had this retracement here, and if we do a Fibonacci on this retracement up here, you can see we've almost done about a 38% retracement. So we could easily do a 50% or even a 61% up here of this move. And I'm sure this is going to convince a lot of people that we're in some sort of new bull market and the growth trade's back on, but I'm not so sure about that because the valuation spread between growth and value stocks is still at historical widths as well. So I wouldn't be surprised if we do come back up into this zone around here over the next few months or so. But overall, in the medium long term, I'm still bearish on growth stocks versus value, but based on the valuation spread. And tech as well, similar story. Look at this, we've just ripped really higher up today. And I think we could be getting a bit overcooked here, similar to February 2 on the whole tech thing. It's not something I want to fight. I've actually reduced tech short exposure, but as this could go further. But short term, we're looking a little overstretched here. But again, if we look on a monthly and 3 month, we can see the spread actually shot up just above what we had back in the tech bubble in 2000, and massively outperformed since the lows back in 02. But again, I just find it hard to call a new structural bull market in NASDAQ. One could argue that this bull market's not even over. We haven't properly broken through yet. If we just look on the Qs themselves and maybe put on a log chart, you look at the log chart of what happened after 2000 compared to now, it looks like just a pullback in this bull market. But I'm not sure that we're going to break out to new highs here because, again, on valuations and with inflation and where rates are, and we don't know for sure whether rates have topped or not. So for sure, the tech sector is loving it right now with low rates, but let's see what happens next week when the Fed meets on Wednesday. I think they're likely to do 25 basis point hike now, but that seems to change day from day with what's happening. But as long as we're seeing moves like this in NASDAQ, then Jay Powell's got every reason to hike into that. So moving on, Smalls. Smalls actually made new lows today relative to SP and really oversold down here, the small caps, because obviously they got the regionals in them, but trying to form a base on this big spinner. Yield curve kind of just sitting around this 0.59 level. High yield versus Treasuries had a nice bounce back today, so there's a bit of risk coming back on into the market. And the 2-year got to around 416, is holding on, could be putting in a bit of support there. Now we can see that we've had support here on the 10-year around this level, and that seems to be holding there. So that'll be interesting to see whether we do hold this 340. I think we did get a bit crazy there and it's bounced, and I wouldn't be surprised to see a 50% retracement. We get back above 370 on the 10-year. Fed fund futures increased today too, so that's those probabilities increasing of a 25 basis point hike, but still well below where we were just a little over a week ago now. Treasuries came off a bit and high yield bounced back a bit, but it's still weak here. We've still got a bit of ways to go before it gets even to touch the 50 bar VWAP. So still a weak environment. I think this is just a bit of a sigh of relief rally across the board. Dollar was a little flat. Bitcoin sitting up here at its range. I think there's a good chance it could break out, especially if there's more bad headlines with banking and stuff. There's just more people who are just going to physically buy Bitcoin instead of having a bank deposit. So I think that's good reason for Bitcoin to break out here as well. And commodities managed to just hold on a little bit. They couldn't make new highs today, but didn't make new two lows. So a little bit of indecision inside bar there. Gold sitting up there with a higher low, but it couldn't make a higher high. It's got an inside bar as well. I wouldn't be surprised to see gold break out next week, especially after the Fed decision. If the Fed didn't hike, I'd say gold could break out. But if the Fed hikes, and depending on what guidance Jay gives, I think gold might just kind of consolidate around this level. Oil flat, little bounce in natty gas, and pretty good bounce across the board today. Gold miners was the only sector that was off, and semis had a really big day today, which I'll get to in a bit. And tech, of course, was the winner, getting up to the highs back here from early February, which I'll look at in a bit as well. Oil and gas had a nice little bounce. Regionals had a bounce with coming in to save First Republic. And the defensives holding up there as well. Utilities look to be one of the best performing sectors at the moment. And over to popular stocks, BlackRock Barometer is actually trading a lot weaker than the market. And I thought I'd just show you today the SP500 versus the BlackRock, because sometimes when we see divergences in these two, BlackRock normally gives the heads up, because it's based on flows in the market, and everyone close to the stock company can probably see what's going on and make the decisions according to that. So if we go back to the start of this bear market, and we just draw some lines, we can see, so we've got the S&P 500 in this orange line here, and we can see here that the market rallied from this point back in early November into early January. However, BlackRock at that same point time did this. So that was a divergence between BlackRock and the market. And then look what happened. We all know what happened. The bear market started in January 2022. So BlackRock's price action kind of forecast that better than the market. And if we go back to where we are now, we can see that the market from this point here to this point here has gone up a little bit, or at least flat. And at that same time, BlackRock has done this, even bigger divergence. So the market's holding on here, but BlackRock's coming off a lot. And I know this is just one stock, but their success is based on the inflows into the stock market, inflow to their index funds. And we're trading really weak price action down here in BlackRock. So that to me is bearish for the overall market. JP Morgan just holding there today on a bit of an outside bar day, looking like it's trying to reverse here. I'm not sure if it will, but it looks like it is trying to with all this volume on an outside bar day. And mega cap tech, look at Apple trading up to its highs here. We've got this overhead resistance as we do in a lot of stocks. And I'm not sure we're going to get above this next week or not. And if we just look at a weekly chart, we can see that there's a lot of overhead resistance around that 160 level, high 150s for Apple. So we'll see if what happens tomorrow, next week, whether it can get above that. And look at Microsoft. Looks super extended here, up 4%, and once again coming up to this resistance level that it couldn't take out. Amazon as well, nice pop up. And Google, they're all above their 50 bar VWAPs. And Meta as well, breaking out again. And AMD, the semis just ripped today, got upgraded, and a lot of people jumping on board. Unfortunately, we had to fold our Nvidia short. If you saw me saying yesterday, I knew it would break out, but I wasn't sure whether it was going to be a fake out with a big wick or a breakout. It looks to be the breakout. So we're not going to fight this AI hype train. The longs seem to be winning for now. And it might have just got too bit of an obvious a short. And I think there was a few people talking about shorting it because the valuation is ridiculous. Just to recap, we've got a $630 billion market cap, and last year their sales came off at $26 billion, and they made $4 billion in profit. So that gives them a price to earnings of 139, to give you some context. So a PE of 139, it is ridiculous, but this, like I said, markets can do crazy things. So the AI hype train is well and alive. This thing could easily see 100, and we'll just go out to a monthly chart here. We could come up and see 300, and who knows, we may even test all-time highs around 350. But I'm sure this will eventually roll over. We're up from 2015, so in the last 7-8 years, it got up over 70,000%. So nothing in the history of markets that has moved like that has ever been sustainable, because they all eventually, bubbles pop, or the competition comes after them, or they get complacent. And if you go look at insider sales, well, I can show you right now real quickly. Let's go look at see what insiders have been doing on Nvidia. Sell, 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 sell. there's the CEO right there, selling $143 million of stock at the top. And again, and again, and again. Every time the stock pops up, he's going to sell it to you. So right now, I wouldn't be surprised. We get reporting next week. He's been selling into this. So everyone jumping on the hype train, getting excited. The CEO and all the insiders are selling to you. They're not buying the stock. Take off that Congress. Insiders doing nothing but selling. So something to be aware of for those buying. You're buying off the insiders. You're on the other side of their trades. But moving on, we'll keep this on our watch list. And if it gets to 300 again, we'll probably have another dig at shorting it. But again, with a stop, because we're not going to fight a crazy market like that. Netflix, high low, looks to have bounced off this level. And Tesla was up 2% again today, but kind of just tracking a bit sideways here, which I think is going to be the pattern going forward. We can see volumes tapering off again here. And I think we'll find some sort of middle ground around the 50-bar VWAP. And I think this 160 will hold. And I'll be surprised if we move a bit above 200. So I think we'll just track sideways there in Tesla for a bit. Moving on, meme stocks had a great day. Meme crowd's feeling alive, buying calls, calling for rockets to the moon, posting lots of memes and getting excited. We'll see if they're going to be right. And the banks held on today and popped up a little bit, with them all getting together to save First Republic. So First Republic was up 10%, but look at this. After hours, we're off 24%. I'm not sure what's happened there. If we've got any news come out. Doesn't look like it. Something might. So, like I said, these things are turned into casinos. This is not a penny stock. This is not some little crypto coin. This is one of America's biggest banks, off 25% after hours. So I'm staying away from the regionals for myself and for my clients. I don't want to touch these things. They could just go either way. I think a lot of them are going to turn into zombies, and this storm is well and truly not over yet in the banking sector. And it's kind of hard to see. We've got all this mess going on, how that's good for markets. But anyway, that's a bird's eye view to all we're going today. So a bit of green out there today. But I'm not sure whether this is sustainable in tech here and the market overall. Something I wanted to do different today was just show you what traditional indicators are telling us. So here we're looking at the McClellan Oscillator. It's something I've followed for years. It's a really good breadth indicator, showing the differences between advances and declines. And it can be good for absolute levels, but I like it more for divergences. So we can see back here, when the market flattened out, we had a nice little divergence there, tipping us off. Same with back up here. The market kind of rose and it came off quite a lot. We didn't really see that bullish divergence here on the McClellan. If anything, you could say we're still in a bit of a bearish divergence. If you call us flat there on the market, and then the McClellan has actually been pointing down. And same with MACD and CCI and RSI. They didn't really show any bullish divergences that we typically see down the bottom. You can see here the RSI diverged, so did the MACD, and so did the Commodity Channel Index as well. We didn't really see that on this low here, so I'm not sure that is the low. And the MACD is still actually in a bear trend on the SPX. So let's go over the NASDAQ, the big one. So the McClellan only looks at the NYSE. I've got it on here. But the RSI, if we do on here on the Qs, and then we look at the same period on the RSI, slightly diverging, MACD diverging, and the CCI somewhat diverging, but pretty overbought for an absolute level. So the CCI is actually at 160, which is pretty overbought. You can see here, last time we got above that was at 195 up here. Another time we got high was 157 here. We got 139 there. And back up here, we got 198 here. So that looks to me like we're setting up on a bearish divergence on the NASDAQ. And if we look at some of the biggest stocks making those moves for us, in Apple, bearish divergence, RSI, MACD, CCI. Microsoft, bearish divergence, and look at the CCI of Microsoft, 255. That is hugely overbought. So I'm not sure whether these moves are sustainable in big tech. Meta breaking out as well, but it's diverging on the RSI, MACD, and CCI. And with that big divergence in the McClellan Oscillator on the market itself, I'm finding it hard to be bullish here. And with the backdrop and what's going on, you've had 3 major US banks fail in the last week. It's hard to get bullish in that environment, even though the Fed's, running around in circles trying to plug holes here, there, and everywhere. I don't think we're out of the woods just yet. We did get a bit oversold here, technically oversold, and put in some volume and had a bit of a bounce here like I thought we would. And for sure this bounce could spill over and we could test these recent Feb 2 highs tomorrow into quad witching and into next week. But we've got Fed decision on Wednesday, and I think Jay will do 25 basis points. It's hard to see the market kind of rally and him just pausing, and then the market rallies even more and tech's just breaking out. Well, we've still got persistent inflation there, and unemployment hasn't ticked up yet. So he's got the excuse to raise now. And if we don't see any more big bank, runs or, big bad headlines from the banks, then between now and Wednesday, I think they'll go 25 basis points, which should see rates pop up a little bit, and maybe tech pulls off and this bearish diversion plays out. But as it stands, I came today 20% net short. With this big pullback now, I'm betting against it in my own personal account. So all my positioning I'm sharing on these videos is just my personal swing trading account, which I trade really aggressively and do all sorts of trades in, so I don't run my clients' accounts based on my personal swing trades. I have separate strategies that I run for clients that I also invest in myself. But on these videos, I share with you how I'm personally positioned in my swing trading account. And I'm, like I said, which I trade relatively aggressively. I like to, try and take the trades that no one else does. And so going into quad witching tomorrow, I think things could get interesting. For sure, we could rally up again. It's probably even a better chance to add to these shorts coming into, which will probably add to the opportunity to get short coming into this resistance. So, like I said, I find it hard to get long this market, and I increased my personal positioning to 100% net short going into tomorrow. And of course, we'll watch the price action data and news as it comes in day by day. But for now, I'm going to stay short this market, and I think headline risk is on my side, and with these bearish divergences coming up to resistance here, I think it's presenting a good risk reward opportunity. Okay, so that's all I've got for you today. Thanks for tuning in, and tomorrow could be a spicy one with quad witching, so we'll see what happens, and I'll see you again tomorrow afternoon.